Welcome to this next presentation of financial analysis, where we will be looking at how good the company is to adjust or adapt the capital used or the capital invested in the company. How much capital should a company actually use? Now, if I told you that I have two companies, one of them I have invested 1 million, and it has a yearly turnover of 1,000, then you instantly would say, well, you use a lot of money to get that 1,000 turnover. And this is actually what it's about. We are measuring the capital, the money used in the company, and compare it to the level of the activities in the company, or measured by the turnover in the company. So the company's capability to adjust invested capital to the size of turnover. And we use different key ratios to look and to evaluate how good the company is to use the capital invested. So when we talk about the key ratios, you can see here that what we are doing is to compare the activity level measured by turnover towards the total investments in the company measured by the balance total. This is what we call the assets turnover ratio. And it's giving an overview of the ratio of the invested capital measured against the turnover. So let's say the turnover is 2 million and the total balance is 1 million. Then we have a turnover ratio of 2. Now, if we reduce our capital investments to, let's say, half a million, and we still have a turnover of 2 million, we'll have an asset turnover ratio of 4, because the balance, the total investment, has been measured or turned over 4 times over a year. And it's of course important to say that the key ratios here are for a whole year. Okay, so for this year here we have a turnover ratio of our assets for so and so, and we can be more specific, because when we talk about the total balance, that could be, the fixed assets or the current assets. And under the current assets, we are talking about the inventory or the debtors. So what is it actually that we have, let's say, put our money in? What is it that the company has used the money to? We can see that in the balance. So all under the assets. So all capital used, we know that it's the assets in the balance sheet. And of course, you can say, well, it could be changed over the year. So what is the average of our binding capital, for instance? You could say, do we take from the starting point or the ending point and put them together and divide by 2 and have an average capital used over the year? Well, there are different methods. I think the traditional way is always to take at the end of the year. But be aware, it's not a law. So it's depending on what company type it is. Is it changed a lot? Or what are you used to do? But the normal thing is to take the balance at the end of the year, compare it to the activity for the whole year. And if you want to look into what is actually happening in more detail, you can go down and say, well, I would like to calculate the fixed assets turnover. And again, it's the fixed assets compared to the turnover. So this is the formula: turnover divided by fixed assets. And the current assets, you can take to look into the inventory and debtors. They are normally the main components of the current assets. And the inventory, of course, well, you're not measuring against the turnover, because the turnover is made in sales price, whereas the inventory is, what we have bought it to. So that's the cost price. Therefore, we here take the cost of sold goods and divide. Sorry, here's a mistake. I have to change that. It's the cost of sold goods divided by the inventory. I'll just change that. So now it's correct. So here we measure our inventory towards the cost of goods sold. But again, we're going to see the same thing. How big is our inventory? Are we good at, supplying just in time? Or is our purchase manager buying too much stock, meaning that we have a lot of value committed into our inventory, even though that we are not using very much. So of course, we have to take care of this resource of our capital, our liquidity, and use our capital wisely, not just to have it laying in, binding it up in inventory and fixed assets. Okay. So creditors turnover ratio is a little bit different from the others that we just spoke about, because you can see fixed assets, inventory is also an asset, debtors is an asset. However, trade payables is a liability. And when we're talking about the turnover ratio of the previous one here, asset turnover ratio, fixed assets turnover ratio, and so on, all those we would like to have a high, from an economic point of view or capital use point of view, we would like to have a high ratio, because that means that we are very effective in using our capital. So if we have a very low capital use and a high turnover, we will have a high ratio, right? So we are not using very much capital. Now it's quite the opposite when we're talking about the liabilities, because that's financing, and we would like to have some, let's say, free cash, free financing. And of course, if our suppliers are saying to us, well, you don't need to pay on a short-term basis, we can grant you a credit for 2 or 3 months, and so we will be happy, because that's a very cheap financing. So here actually we would like a low figure, because that means that we have a high debt to our creditors, trade creditors, and that's financing free of charge, right? And we measure that against the goods that we have purchased. Now, the goods that we have purchased, we cannot find anywhere in our profit and loss statement, because that's the cost of goods sold. And we cannot find it in our balance sheet either, because that's the stock we have over there. So we have to calculate the actual purchase. And what we can say is that, well, what we have on stock at the end of the year, well, we have probably purchased that at this year. If not, then we will be on stock at the end of the beginning of the year, so we can deduct that. and the goods that we have sold this year, we have also bought. So the purchased goods of this year is the goods that we have sold, plus the goods that's still on stock, minus the goods that we had on stock when the year started. And that we can measure against our creditors or the trade payables. Okay? And we would like to have a low figure here of the turnover ratio, because that means that we have a lot standing here on our trade payables. So all these figures here can show us how good are we to economize with the use of the capital. Okay? And we can just make some calculations here. Assets turnover ratio, I can take the total assets. I have it here, the total assets in company. And I have to divide that up in the turnover. Well, so actually I should have started with the turnover and divide with the total assets like this. And let's see. So it says 2.55. So 2.55 times the total assets has been turned over, so to speak. And you could also say that the turnover is 2.5 times bigger than the capital employed in the company. And I can draw that over here and see the development. And actually, we have a higher turnover of our assets in 2017, so it's a good development. Fixed assets turnover ratio, I'll do the same thing, this time starting by taking the turnover and divide by the fixed assets standing here. Okay, so that's 21 times decreased. So maybe we have, well, we can see the fixed assets. We have been doing some investments here, so it's increased. So we have more capital applied for our fixed assets. Inventory turnover, that's our goods on stock. And we know we have to measure that against not the turnover, but the cost of goods sold, and divided by the inventory. That's 9 times, 10 times. Can I draw that? Like this, yeah. And it's getting even better for 2017. And you could also put it another way, that you can say that our inventory has been turned over around 10 times. So that means that our goods in average will be, well, we say 360 days for a year, 360 days approximately, right? And 10 times. So it means it's on stock 36 days. Now, is that a long time or is it a short time? Do we want our stock of goods being sold? Do we want that to be on our stock for 36 days? Well, it depends on the business you are in. Debtors turnover. Let's see about our customers and the turnover here. How long time? How much credit we're giving our debtors? Trade receivables, the same thing as debtors. That's what we are going to receive, hopefully, from our trade. And it's 3.47 and 4.4. So you could say now it's a long credit that we are giving our debtors. I can just for the fun here say 360 days divided by 4. It's actually 82 days in average that our customers have a credit. And if we're saying 30 days a month, right? So it's 2 months and 20 days. It's a long credit. But it depends on the competition and the line of business you are in. Okay, and the last one, creditors turnover ratio. And here we would like to calculate what is actually the purchase. So I will say the purchase is what we have used of cost of sold goods, and here we have a problem because I need the inventory from the beginning and the inventory at the end of the year, and I only have inventory at the end and the beginning of the year for 2017. So actually, I will just go down here and say I can calculate the purchase, and that's the cost of sold goods plus the inventory at the end minus the starting inventory. So this is the cost of goods sold, and I'll put that in brackets, and then I will divide it by our creditors at the end of 2017 and trade payables here 2000. And you can see here that our creditors is 8 compared to our debtors, which are 4. So you can say, well, we are paying our suppliers twice as fast from this point of view as our customers are paying us. So we definitely have some financing issues here to work with. Okay, and we can see how we can comment on it. So we'll talk about the level and the development of Ator, and we can say why is Ator developing as it is, using the next 3 ratios to explain it. And in this case here, we can say, well, we have an improvement in the assets turnover ratio, and it's probably due to the inventory and debtors very good development, because the fixed assets turnover has actually not improved. We can look at it in more detail by showing the relatively change. So I can calculate the change here, put that in brackets. It's 3 minus 2.55, and I want to divide by the starting point, so I can say how much has it changed in percentage. And we have an improvement of 18%. I can copy that down. Okay, so we can see here that the more effective use of our capital is being 18% improvement, primarily due to our good managing of our debtors, that we have been able to making our customers paying more quickly on a shorter term. Okay, so this was about measuring how good a company is to use capital in an effective way using these key ratios. Thank you very much. Hope you enjoyed it.